U.S. economy just on fire in the third quarter, a rate beating all expectations. The revised third quarter GDP crushing 5%, but those gains could be short-lived. Karina Mitchell explains from New York City.
We are starting to see some cooling in the fourth quarter, which is a big difference from what we saw in the third quarter. Businesses are starting to hire fewer people and consumer spending starting to soften a little bit, although you wouldn't know it from those record Cyber Monday online sales that we just saw. But that cooling is starting to set in at this point. But it's in stark juxtaposition to what we saw in the data that came out today from the Commerce Department. The second read of third quarter GDP came in at an expanded rate of 5.2% annually compared to 4.9%. That was the estimate. I have to point out just how remarkable that number really is, given that we're in this environment where we're in a global sort of economic slowdown. The U.S. has been far more resilient and has held up much better than some of the other leading economies of the world. Let's look at some of the factors that helped this expansion over the summer. For one thing, government spending increased both at the federal level and at the local level as well. Businesses started investing more money. That's as they saw more profits come in. We also saw imports and exports increase as well. And consumer spending, though it was dampened a little bit, it was a little bit softer, it did help create growth as well. And I want to delve in to give you a little bit of a closer look as to what the consumer looked like over the summer in the third quarter. Personal income spending. Personal income increased by just above $200 billion, which meant they had more money to spend, more disposable income. That went up by $144 billion. So although they're being more thoughtful about where and how they're spending money, they are still generating enough sales and buying enough goods to help stimulate the economy. So they continue to be the hero of this U.S. economic recovery. Remember that consumer spending accounts for about 70% of all U.S. economic activity. The big question is, how long can this momentum continue? As I said, we are starting to see some cooling in the fourth quarter. Many analysts predict that we will see growth for the final months of the year, but it will be more anemic. It will come in closer to 1.1 or 2% for the quarter, but that's still better than seeing negative growth. Obviously, 2 quarters of negative growth would signal, traditionally that we are in a recession. And then household spending, as I mentioned, is contracting. The estimate for the third quarter was 4%. It came in at 3.6%. We are expecting to see more cooling come in. And it's because of this high interest rate environment that the Federal Reserve has created here in the U.S. It's working. It's slowing the economy and it's doing what it's supposed to do. But it hasn't broken the consumers back. They are still willing to spend money. They're able to do it right now. And so we're in what really is this Goldilocks environment. And it could lead to what many believe could mean this soft landing that everyone's been hoping for and talking about. We'll have to wait and see. Karina Mitchell, CGTN, New York.
We're checking out how the U.S. markets reacted to all of that. John Terrett from the NYSE.
After the closing bell on Wall Street on the Wednesday session, Salesforce, which is an exciting company that helps people improve the way they conduct their businesses and which is a Dow Jones component, gave us their earnings. They beat with their earnings. Their revenue came in bang in line with expectations. Their shares were up 3% in the aftermath of that news. On the Wednesday session, we had GDP at a very healthy 5.2% revised upwards. Markets largely overlooking that, though, I think because, by and large, most Americans don't really feel it in their pocketbooks. Now, we did have a rally, but it ran out of steam in the final hour of trading. On the Wednesday session, gold was up $5. We had Brent and WTI up, and the two key yields, the 2-year and the 10-year, were both down, with the 10-year at 4.2%, below 4.3%, and that helped stocks. So the Dow was in the green but flat, up 13 points at 35,400. Nasdaq was down 1/16 of 1%, 23 points. S&P 500 flat, down 4 points at 45.50, but on pace for its best week since July 2022. And on Thursday in New York, the earnings continued to come in, this time from a once giant name in home computing, Dell. Also Kroger, which is, I think, the largest supermarket chain in America. Pretty sure it is. And Ulta Beauty, which will sell you anything to improve your skin and make you more beautiful. And I'm heading there right now to buy lots of products. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
Always good to see John joking around. For more on the economy, Arthur Dung, teaching professor at Georgetown University, McDonough School of Business. Always a good school and always good to see you. Joking aside, this economy, we have been talking for the past 12 months, oh, we might be in a recession, things are slowing down, rates are going up, home prices are too high, and all this whining that we have done. The bottom line is we haven't seen the job losses they were expecting. The home prices remain high. People are spending money. Airfares are up. Hotels are up. Nothing is stopping this economy. What's going on?
Yeah, thank you, Phil, for having me on once again. Yes, despite all this gloom and doom, the American economy continues to power forward. Today's Beige Book report certainly indicates with a revision upwards of 5.2% from 4.9%. And all the data that's coming in certainly brings into sharp focus that the recessionary fears are starting to fade. And indeed, the fear of missing out in terms of the stock market are starting to take hold. And so just as your reporters had just indicated minutes ago, all the data and consumer sentiment is pushing in the right direction. The American consumer is still alive, and that's certainly shown up recently with the Black Friday and Cyber Monday figures. The National Retail Federation signaling that over 200 million American citizens participated, and they anticipate this to be a really good Christmas in terms of overall sales.
I mean, it's crazy because just a few weeks ago we were talking about how the economy might not be doing well and the consumers will spend less and all these extra costs, right? I haven't even mentioned inflation, but isn't there something about the U.S. consumer that's very different? We keep talking about, you know, the end of the world, and it's very negative, right, when we talk about the economy. And I've spoken to consumers out there. They're like, the hell with it. We're just going to spend. We're going to buy. We're going to take on debt. We don't care what happens. And there's that mentality of almost blind optimism that strangely is fueling the economy, which is exactly what the Federal Reserve doesn't want to happen. They want people to slow down spending. So we're really going against what the Fed wants, aren't we?
I actually think a lot of this sentiment is structural in nature. So long as American citizens have jobs, and the employment picture is, it's still a tight job market in the United States. So long as there's no fear of a future job loss, they'll continue spending today. So long as they know they can continue to pay those credit card bills, you know, in the months ahead. And so it's this sentiment, this sort of lack of fear of job loss that is really, you know, fortifying and propelling the American consumer forward at the present moment.
So if we drill down to the details of what the Fed wants inflation at 2%. We're a little bit above that, and I think they were expecting perhaps GDP to slow down a little bit more, which it hasn't thus far. I know it might later, but if that's the case, the Federal Reserve is going to look at this and go, well, while what we've done has slowed a bit, it's not enough, and if the economy remains strong, isn't that bad news for inflation into the future?
Well, the recent data seems to indicate that there is a degree of softening in terms of the job market. 6 of the 12 Federal Reserve districts have reported a softening in employment. And so the trend line is clearly going in the right direction. The escalation of interest rates over the last 18 months are starting to have that impact. And if anything, financial markets are actually anticipating rate cuts in the first quarter of 2024, believing that the Fed's impact and in terms of its rate activities is certainly having an impact on inflation, and that the picture may indeed clear and become much more bearish come 2024.
So let me get this straight. You think that 2024, maybe not quite as good as this year, you think it'll be a little bit worse, but we are not going to have a recession. So I'm assuming you are in the safe, soft landing camp, no?
Yes, certainly. Allow me to correct myself. Forgive me. I meant to say bullish. And so the bull case is starting to take hold in financial markets. And we certainly see that in the markets today. Month to day, all the averages are up. The S&P is up at over 9%. The NASDAQ is up over 11%. and the Russell is over 9% as well. All the averages are pointing in an upward direction. And a lot of that sentiment is that markets, as well as myself, believe that the soft landing scenario is coming into sharp focus.